I'm like,
Matt Santagapita, Santa knows best.
Andrew Young, Mortgage Wise Financial, and the Community Mortgage Movement.
And we're going to talk about, I guess, what is this now? Is this round 2 this year from the government changing mortgage rules and kind of going down crazy lane is what it sounds
not
like.
Not a lot of dust settling right now.
No. So Andrew, explain this just kind of quickly, like all the little changes that they're looking at doing, and then we'll maybe dig into them a little further.
Sure. I mean, the first change, just to kind of give you a little bit of a background, is in October 16th of 2016, they made the changes where if you're putting less than 20% down, you have to qualify at the benchmark rate, which is set by the major banks. Okay, and maximum 25-year amortization. So that's a change they made last year. So to spell that out,
let's say if today is like a 5-year fixed rate, just because that's probably the most commonly looked at number. Let's say it's 3%.
Fair.
What does normally the real benchmark rate look like?
4.89% currently.
Yeah.
Okay. Yeah, absolutely. So the new changes that are coming in place January 1st or sooner, because a lot of the banks are going to start implementing these soon, a lot sooner than January 1st, just to be ready to roll out the 1st of 2018. It affects people that are putting 20% down or more. So what the government is doing is making sure that these people that are putting more than 20% down can afford a large rate increase. So what that means for us, so instead of qualifying at the benchmark rate, they now have to qualify at whatever their contract rate would be. Let's just call it 3.09%. Plus 200 basis points. So now we have to qualify these people at 5.09% as opposed to 3.09%.
Yeah. So 200 basis points, that's 2% on a mortgage.
Exactly.
Just to kind of like spell it out.
Absolutely.
Okay. Typically, like a conventional mortgage is when you have 20% down or more, which generally the market looked at that and said, if you have 20% to put down, you're not as big of a risk from a lending perspective. I just can't understand the logic here. Like, there's two things. One, I don't understand it, period. The only thing that I can see is literally they're actually probably trying to push people to put less money down and get an insured mortgage. Now, why? I have no idea. That's either because the government wants money or they just want to try and shelter people from something bad. But again, that goes back to just paying a mortgage, paying an insurance premium. Like I don't understand it. It doesn't. Where's the logic here? Why are they doing this? What have they told you guys that?
Well, you asked about the word logic, and I can't say that it's a logical move. What I can say,
other than they maybe see it as this will cool the market,
sure,
like officially 100%,
even
put a lid on it,
up to anywhere near 20% to cool the market down. So the market may slow down up to 20% based on what everybody's forecasting. So the biggest thing that I see is they want to move money off of the bank's balance sheet.
Okay.
So if it's not an insured mortgage, that bank is lending its own money.
Yep.
So it's seen as riskier to the bank. It's not to lend that money off their balance sheet.
Yep.
I think you're right when you're saying they're trying to push everything to insured mortgage. So CMHC, Genworth, CG, that mortgage will be paid. The payments will be paid if the people stop paying those payments. So they're trying to make it less risky of an environment for the banks itself. But what they're actually doing is they're penalizing those who have saved a lot more money or have received a larger gift. And number one, they've already made it so that these people are paying a higher interest rate, and now they're making it more difficult for people with a larger down payment to get into the market or to move into the market, make an upgrade to their housing.
Kind of feels like it's almost backwards thinking at this point.
Absolutely it is. We've been lending to people with a larger down payment, and that's faster approvals because there's less risk, and we've been doing that for a number of years. But now it's kind of flipped on its head, and now we want more insured business, and we're rewarding those buyers with better interest rates than those people with larger down payment.
So if you're saying and I mean I've read articles and they say anywhere from a 10 to 20% kind of reduction in activity. So last year, London St. Thomas Real Estate Association, there was roughly, call it 10,000 transactions. So literally we're talking about peeling that back anywhere from 1,000 to 2,000 transactions, which is huge.
Absolutely.
But like, what other, what does this do for like buying power too? I mean, we're not just talking, like unit sales are going to go down. Affordability is going to plummet as well. And are they? It's that same 10 to 20%. Is that?
It's
is
20%.
That so it's 20%. They're like, no, it's 20%.
Between 20 and 21% is what the average person is going to be. Their buying power is going to be reduced by approximately 20%.
Average home price in London right now, you're about call it 330,000, just for argument's sake, so like 328. But your $330,000 average home purchase price. So right now, if you can afford then 330, you then now have to look at that, and in the coming year, that affordability is going to go from 330 down by $66,000.
So it's going to $270,000.
Yeah. Now anybody who's out there shopping for a home right now or has in the past 18 months, 270 to 330 is very different. But then also, so like, let's keep moving up. Like, I mean, you get into a new construction home, like everything's 400,000 right now, new build, like no matter what. So now all of a sudden a $400,000 new build from a buying power perspective, that now is going to come down to 320. Like, and then 500 comes down to 400, like,
it's a big ripple effect.
Yeah, like it's kind of like, you know what I mean? Like it's like, I'm gonna just take this cord and shock you. Like that's like,
it's jarring. It's a jarring change, and we've just went over the 1 year mark of the last changes with the insured buyers.
Yeah.
So they're gonna reduce the buying power, which means they're gonna slow the market right down. And then that's going to raise interest rates, I imagine, again, for those who have a conventional mortgage. Or it's going to add a lot more co-signers.
Yeah.
And then it's going to increase down payments even more if they have to go that route. So they have to make up that difference. So if we're 330, now we're 270. Now I have to come up with another $60,000 to make up the difference.
Well, and it's so, yeah. And so I guess, like, I mean, here's the other thing. They say, for every, I think it was, every 3 transactions, that generates $50,000 of spending in the economy.
Right.
So basically now when you start looking at the numbers, okay, growth in Canada is sitting at what, 3 to 4%?
That's pretty high, I imagine.
Mid next year, we're in a recession from this then.
Absolutely.
Literally, we are in a recession because of that, the shock and what it will do to the economy.
The numbers that the economists are putting to this is if these changes come into place, and it's like, I think it's 54,000 for every 3 transactions that's generated in the city, the size of London. So extrapolate that to the GVA, GTA. So they're talking about jobs.
Like that's billions.
Jobs, absolutely. That's jobs across Canada, 100,000 to 150,000 jobs that won't be created.
Sucked right out of the economy.
Didn't even have a chance to make it. So that's the type of change that this is going to create. And it's going to happen sooner than later.
Now, I mean, from a new build perspective, they'll say, if we did see a bit of a peel back in new construction activity, I mean, this maybe sounds bad, but probably wouldn't be that bad. And I just say that because anybody who has bought a new home this past year, trades are a big issue. There's just not enough of them. So, I mean, I guess it's like you take the good with the bad, but I mean, really here, 20%'s massive.
It's huge.
So here's a question. What the heck are they going to do after that? Okay, January 1 comes in, maybe like start of December, the banks will start to roll it in, and you'll have like loosey-goosey decisions on whether or not you really have to do that, and they'll be somewhat selective, right? We know that's going to happen because that's the way the banks kind of are on things. But what the heck's going to happen come March when they realize, wait a minute, like this really was like we just shoved things on life support. We gave the market a heart attack here. Like, do you see them reverting back? Do you see them coming out with some other mechanism that maybe makes it easier to handle this? Like what?
So
what can they do?
The unfortunate part is this is going to start putting people and pushing people towards more expensive financing. So with a lot of AAA lenders, and by AAA lenders I mean banks, credit unions,
like major chartered
lenders,
banks.
exactly.
Okay.
So those are A lenders.
Yeah.
So you're going to push a lot of buyers into what's called a B lender, a higher interest rate, higher risk lender.
Yep.
So they have different criteria and different guidelines in which they underwrite. So now we're talking about taking people from a 3% interest rate up to a 4.99, 5.99 interest rate
just
for
so
a
they can
year, 2 years,
more
just so
home.
they can go into a home, because their guidelines with their total debt service ratio calculations, that sort of stuff, they're a little bit flexible. But you have a shorter term but higher interest rates. So what they're going to do is they're going to make lending and borrowing a lot more expensive by 1 to 2 to 3%. That's scary numbers.
Yeah. Well, I mean, I like what you increase your mortgage rate by what, 2% on $500,000. What's it, probably $500? I don't even know.
It's more than that.
Is it more than that?
More
okay,
than
yeah.
that.
So, yeah, I mean that's. I mean, so like it's like let's try and find the logic in here.
Yeah,
like,
it's a hard pill to swallow. So now if they're looking to shelter people from an interest rate,
I think they're making the wrong decision here. This is the wrong move.
I completely agree with you. So if they're trying to isolate it, what's going to happen in 5 years is, number one, you're going to pay a portion of your mortgage off. That's a big factor, right? Number two, you need to look at what your salaries look like. So chances are, if you get a 1% raise, 2% raise, 3% raise a year, then you're 5 to 10 to 15% of an income increase. So you can afford more. And the other thing is, are the interest rates going to go up 200 basis points or 2%? I don't see the strength in the economy where they can make that move.
I mean, we just you want to talk local economy here. I mean, Cami just went back from going on strike. That didn't look good. I mean, Fanshawe teachers are on strike, and I mean, everybody has a reason for doing whatever. But I mean, there's nothing really robust and amazing in our economy other than housing and new construction. Like literally, that right now is the beating heart of our economy.
It's the first thing you hear about when you turn on the radio, when you look online, when you're Facebook. Here's what is going on with the real estate market. This sold this much over asking price, and it's been that way for a long time. And what I find was unfortunate is they introduced the new changes in 2016, and ever since that, every single month was a record month. Month after month after month. So those changes didn't work. So I don't know.
So now they're just
these changes are actually going to work.
They're like, okay, fine, market, you don't want to slow down. We'll just
slow you down.
We'll just push you off a cliff.
Turn the tap right off.
Okay, so obviously, if someone's in the market to buy or refinance, maybe they literally should be looking at their options right now. Get this stuff figured out.
It sounds like such a sales approach, like get in here and do it now. But get in here, do it now.
Things are going to change.
Because things are changing.
Do you think it'll be literally, like you say, like they're turning off the tap? Is it January 1 that tap's turned off? That's when we're going to notice it? Or are you thinking it's going to take until February, March, maybe July, whenever? How soon do you think this is going to actually go right off the ledge?
As soon as December.
Wow.
Maybe even earlier, because the lenders have to implement certain changes within their internal structure and the way that they underwrite everything, the numbers that go into the programming. They have to change everything. So for a smooth transition, Jan 1, you're looking at probably mid-November, early December at the latest for a lot of lenders. So yeah, if you're looking to refinance, if you're looking to renew your mortgage, get things done before the changes are made, and that'll make sure that you can get the changes done and at an affordable interest rate.
Yeah. All right. It's Matt Santagapita, Santa Knows Best.
Andrew Young from the Community Mortgage Movement, Mortgage Wise Financial. Changes are coming.